Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to cover in the Econ Show a pretty broad amount of topics, but the biggest focus on, especially in the first part, is going to be what does the yield curve mean? Why does that matter so much when we're looking at what is future growth? What is going to happen with the central banks, their activity? And we're going to layer that with what's happening with inflation based on prices paid, prices received, jobs, unemployment, housing, now that some of the housing has come out and that inflation component coming back in, then looking at Europe, and then we're going to do a much broader show on Biden and China, and because there's a lot to kind of break down and what's that wrapped into. Now, before we get into that, we'd just like to remind you, please like, share, subscribe. Your support is appreciated. So when we look at just providing kind of this backdrop of what we're going to be talking about, we turn to the daily indicators. You can see that China is now back from their Lunar New Year, but they're not fully back. And given it's a 2-week holiday, depending on where you are, what your opportunities are. But for the most part, people are starting to get back to normal. And you can see just this pressure that remains in getting back to that normalcy that they were prior to the Lunar New Year holiday. But even before they got to the Lunar New Year, you could see this deceleration activity. Now, that's a mixture of they had their own COVID cases, there were lockdowns that were instituted, but now most of that is gone past. Now, how quickly are they going to snap back? Because as we talked about in the EIA show segment 3, we're seeing some of the slowdown in Asian activity and just what their demand will be for products. Now, on the emerging market side, we're seeing a little bit of an increase that's mostly being driven by India, just based on some of the activity that we've seen normalize. And then when we look at advanced economies, we're still below that dip that we saw prior to the holiday period, and that's starting to close the gap. But again, there still remains some headwinds to how quickly can we close that gap and start to get back into a growth profile. So when we look at let's just take the developed markets first. You can kind of see where the issues lie. Where the U.S. has seen that bounce, we've seen a little bit of a recovery. But when we look at Europe, it's really kind of hit this stagnant period, and that's where Spain has seen some increase. But when we look at Germany, when we look at Italy, and when we look at France, obviously some of the biggest countries in the European Union, we see this kind of this flat line, which again leads to how quickly can they recover. Like when we talk about Germany, we have to talk about car manufacturing, as we talked about last week in the last segment 6. We see this slowdown. There's the supply chain issues, there's demand issues, and we'll talk about that in segment 4, where we go through what new sales look like. And again, there's just this problem that we're seeing overall in terms of just general activity, with obviously Canada and the UK rounding out the bottom. We just want to be able to see the U.S. and Europe start to climb higher, because just looking at the activity level, we're still at about 70 to 75% of which is again 25% to 30% off of where we were a year ago. Now, things are a little bit different on the emerging market side, but as the developed market goes, so will the emerging market, because this is where we get our raw materials. This is where we get a lot of our semi-finished goods. And if we continue to see some impacts on the developed side, that will bleed into what are some of the problems at the emerging market side. And we're going to go through that in more detail in the last segment when we start looking at inflation and what are those impacts to fiscal stimulus, because the developed markets have more opportunities to stimulate versus emerging markets because of inflation rates, just what the underlying economics allow for. Then just to introduce some of these topics that we're going to look at, this is looking at the real 5-year and 5-year forward swap rate in the US, Euro, and Japan. And it's not so much that they're above zero, because clearly they're not yet. It's the pace of move. How fast, and this is where we start looking at the rate of change. The rate of change is what's so concerning, because we're getting this volatility into the fixed income market. Rates are starting to react. We're seeing that long end of the curve, especially in the U.S., price in some of this pain. And when we look at these different impacts, especially when we looking at Forex on the FX side, sovereign bonds, sovereign bonds are weakening in a lot of these countries, U.S., Europe. Europe and the U.S. are the biggest issues when we think about, well, this is where we've seen a lot of this capacity of stimulus, of debt, and who's the buyer of last resort? That's what I always come back to. Who's the buyer of last resort? And some may say the Fed or the ECB. They're the buyer of last resort. But at how much can they buy? At what point do we risk this huge hyperinflation spike? And given the economy is slow, so as we've gone through the velocity of money, that will impact the overall movement. But we're already seeing a huge amount of inflationary pressure across the board, and it's starting to react. And when we look at the bid to cover, that's the most concerning, because the bid to covers, it just means less people are showing up to buy, and they're demanding a higher rate to take on that risk. And the Fed is already buying $120 billion a month. How much more can they buy? What is the extension? Because if we look at what the U.S. government is doing, they are increasing their borrowing, and their deficit is growing, which means we're going to have to borrow more. And this is going to increase the volume just as less people are showing up. And this is where the conundrum comes into, because central banks need perpetual motion. And what is this showing but a slowdown of that motion to a stoppage, which is going to impact their total ability to act and to create a monetary drive, because they've saturated the market. The law of diminishing returns is now catching up in tenfold, and that's where the current issues are starting to arise. Now, this could fade. I'm not saying it can't. It's just, I don't think it does this time. Now, does it have to continue going up? No, it could go sideways from here. But the rate of change is the biggest concern when we're looking at volatility and volume in general, in terms of how people are preparing for the next few months. Now, when we turn to just, as I said, the global debt levels, you can see that now this is the official data as of 2020. We have global debt hits a fresh record high in 2020 as we continue to push higher. And this is with a shrinking GDP. So the percentage of debt to GDP has exploded to new highs, because 2020 was a year of decline. And even though we declined, you can see just how fast that debt really grew versus just the global debt in general. And this is in USD. Now let's break it down into a country level, because not all countries are the same. So just put this into perspective. In 2020, global debt rose by 24 trillion US dollars to come to 281 trillion, or 355% of global GDP. Now, do we grow into that? Unlikely. What does that mean in terms of the slowdown of growth? Because you can't keep stimulating at these levels. You're going to have to see some form of austerity, some sort of slowdown to help try to mitigate some of this capacity. But the question will be, how much of that can be tolerated? What does that mean going forward? And this just gives you a backdrop of the countries that have seen the most. So the U.S. is obviously close to rounding out in that top 10, and the central government is the biggest increase in this capacity. When we look at non-financial corporations, households in general, because everyone keeps talking about the amount that people have in savings, and as we've been talking extensively, yes, savings have grown, but it's at the top two quartiles as the bottom three quartiles continue to struggle because they're living off of savings. So yes, the general government is increasing the payments. We're going to get stimulus checks, but for most that are getting it, it's going to go back to replenish the savings they've been living off of. And there's really no security in terms of the amount of GDP growth that we're seeing, just given the employment issue, which we'll talk about in the later segments. But obviously, when we look at just what's happening in Germany, it's, can't stop, won't stop. It's just we're not seeing the same type of response on a GDP level, growth level, which is the concern that we have going forward. Now, one of the benefits that we have is we've still allowed companies to go bankrupt, or we've still seen companies go bankrupt, because that is an actual benefit. By having this benefit, we're looking at this saying, okay, well, there has to be a rebirth. We have to get rid of some of these zombie companies. We have to allow the business cycle to take place. And when we look at the amount of bankruptcies in the U.S., we've seen that. And when we look at the number of business registrations in 2020, people are getting back to work. They're going out and creating companies. They're going out and trying to innovate. And this is the healthy side of the equation. It's just, we need to see more zombie companies going away. We need to see more capital being unlocked and moved into the market. While in Europe, you've seen a way more protection on the corporate level, on the jobs level, which at the same time creates a certain amount of stifles growth to a point. And that's where you have to have that balance of both. And again, I'm a capitalist at heart, so that's why I say that it's always better to, if it's a great idea, go to bankruptcy. Somebody will come to you, they'll fund you, they'll do something. I've taken companies into and out of bankruptcy. There is a process for it, because we built this country around the ability to fail, get back up, and do it again. And that's something that I think makes us special in that way. And this is something that supports that. Now, we're getting further and further away from that, which is the problem. But again, we're still not away that far from where we have been in the past. Now, when we look at just the surge in fiscal deficits, this is the overarching problem. So we saw the debt increase, we saw the growth in general, but when we look at 2021, you can just see what the percentage of GDP is that is going into the fiscal deficit. And when we look at South Africa, US, China, the ones that we want to talk about at this moment is US and China, because these two countries are already increasing the amount of debt that they're spending exponentially, China in particular. And because the US is over 100%, but China is over 250%. So the increase in their deficit spending is going to become a much bigger issue. Now, the other side of the equation, which is why we talk about the yield curve so much, because there's so much debt, every incremental move in the interest rate is going to have an exponential effect. And that's where the people, investors or in general, there's that missing link of every time there's an increase, the issue becomes bigger because the bubble's just bigger. There's more of it. So any incremental increase, which is why central banks are looking at this so closely, they're going to try to do some sort of yield curve control or something to mitigate some of this inflation, some of this rate risk, because it's going to have a bigger detriment on the longer term, especially as each government is looking to borrow more, not less, with a shrinking buyer of last resort. And that's when we look at, well, what are some of the issues? Now, this is what we've been talking about. The one on the left is looking at the PMI, supply delivery times. This is what we keep talking about, where the delivery times continue to extend because there's the logistical issues. There's some of that normalcy is coming back into the market. We're starting to get some balance. But the input price index is still going higher, and it's expected to continue to go higher even as these logistical problems are starting to subside. Now, starting to subside and having subsided are two very different statements, and they're starting to subside, but they're still not there yet, which is why these input prices are going to keep going higher on a not only demand level, but also just on a supply level when we look at commodities, as we have wheat at a 7-year high, soybeans back up, corn back up, crude at, WTI Cushing at 63.20. We're seeing a huge rally in some of these components, and this is going to bleed through. We can do the same with lumber, pigs or hogs, any commodity you want to talk about. There is the inflation that is only going to continue to push through to the consumer. And that's, again, something that we're also seeing in the rent and housing side, which we'll talk about in a minute. Now, when we look at the excess capacity, because the question then comes, why are we stimulating so much if the output gap, so that's the difference between the actual and potential GDP as a percentage of potential GDP, is tightening. So when you look at the US has the tightest amount of gap to close. And if you want to put, if you buy one GDP point, the view is that it's going to cost about 900 to 990 billion to get to from this level of negative, let's call it 1.7 to 0. But yet we're printing 1.9 trillion. Now, I get there's the K-shape, there's, who's going to get what, which is going to support the bottom half, not so much the top half. So you can't look at it that way. But this is a real question that has to happen, because why are we issuing so much debt, increasing our overall deficit, even though we're having a natural rally back off of the lows? Is it something where we should hold off for a minute, or focus more on the underlying, people who need it most, and avoid some of this overheating as inflation is picking up exponentially from the ground up? But while all of this is happening, this is when we start looking at, well, what's volatility doing? Clearly, we've had some crazy moves over the last week or so, and it's really being driven by rates and really being driven by this move index, which is looking at that rally back up. And when we see the highs that we're going back into, the VXN is still lagging. And that's when we look at what's happening out. And those who know me from last year or that have been reading our research, one of the things that I was talking a lot about was the repo event in September and some of the volatility that was coming into the market as we got into December, into January. And these were some of the fears that I had. And it was really driven based on the amount of volatility that I saw coming into the market. The lack or I should say the rate shock that we had in repo. We've now seen it in Shibor. These are things that are starting to become a bigger problem. And now, while today the equity market is ignoring that, the rates will be the bigger driver and the bigger conversation as we go forward, because this is going to be an overhang to growth as you get that the weighted average cost of capital, or WACC, goes up, which is going to take away and shave off some of these multiples that we've seen in the equity markets. And this is just looking at what that acceleration looks like. And when you can see that here in August, and then obviously in September, we had that spike, and then we had some of that decline. But as we got into January, you saw this reversal in the move index. And that was one of the things that I took as a signal as something was wrong. There was a problem coming in. I started to get bearish the market in July of 19. And here you're starting to see those increases from July as we started to see some of these cracks. And now we're back into an area that I think is concerning and worth watching. Now, could it pull back? Absolutely. Could it go sideways? Sure. Typically, the way this is calculated, it doesn't really go sideways. It goes up or down. But this is why we want to look at it, because this is something that I think the market needs to appreciate in greater detail as the rates become a focal point. And this is just looking at how fast could those rates go. Well, let's look at the world manufacturing PMI, and you can see that we're right back up to this level of about 53.5, and look at where the US 10-year is. Now, there's a wide gap to go, and it looks like we're closing that gap very quickly. And this is, again, coming to some of those issues that we're talking about, where it's really just getting started. And that's the biggest concern when we're looking at how are we going to mitigate this, or what is the central bank going to do to address some of these problems, which when we look at just what the Fed balance sheet has done, how much can they do? And this comes back to what is their propensity to continue to buy? How much can they continue to buy as their balance sheet is only expanding? They're already guaranteeing a purchase of $120 billion a month. While rates are going, while the index or the volatility is increasing. The whole goal was to mitigate that. As you can see, the inverse relationship, but right now the inverse relationship is going away, and how much of that size could actually come through in order to address those issues. as we see these containerized freight indexes. This is looking at just, Europe to China, the west coast of America to China, and just Europe in general. And here you can just see where those containerized freight indexes are going, which is why China is struggling on the export side, because not only are their costs internally going up, but the export costs are also going up, which is just leading to more and more pressure on how much can they actually or really supplement, given the price increases that they've seen across the board. And as something comes across, cotton surges to highest since 2018 as potential squeeze continues. So here is when we look at commodities to equities. Obviously, commodities are on the move, and this is where we start to factor in the base effect, because inflation has been so low, or as they say it's been low. I will disagree, but that's a much bigger conversation. But here's where we start to see this pivot, and we have to consider what is this going to be going forward, especially as we have cotton, lumber, grains, everything in general shifting in the wrong direction. Now, at the same time, when we look at goods trades barometer, you can see that we've started to normalize, which is going to pull up this number. But the leading indicators, as we talked about in the EIA show, are starting to ebb a bit, and we're starting to come back down. Now, we're still above. That's still a positive. We're still back to a better leading indicator, but that's starting to pull back. And which is normal. We're going to pull back, but again, that speaks to why we're talking about this normalization in logistics and some of that calming down on the logistics side, just because there is a certain amount of loosening up in that industry. Now, when we turn to what is happening in the U.S., we have to look at, what are doses doing? So vaccine manufacturers have moved up their timelines for delivering doses. This is a net positive, and really by June or July, you're going to be able to get a vaccine if you want a vaccine, or if you're at a high risk, and you're obviously at the front of the line. So as we get to July, between people who are now vaccinated and or are immune, we're getting closer to that herd immunity, which is has been quoted as the key to getting people back to normal. I push back on that, just given the amount of jobs that have been lost, spending in general. But again, as that's more of an economic issue, where when we look at just COVID as the overhang, it really should abate as we get into the midsummer months. And this is just looking at that progress. Like as we get into July, you're just looking as we're getting to that key point. And when we look at J&J getting the approval, again, all of this is just going to accelerate that inherent activity and the amount of people that may feel more comfortable to move about. Now, in the next segment, we're going to go through the U.S. data in more detail and try to pick apart some of the key aspects that we're looking at that will put some of that overhang into the economic recovery and some of the issues that could arise as we head into not only just the end of Q1, but also into Q2.